Hi guys, this is Shiva. Welcome to Trademark. In this session, I will explain about how to manage risk. It's risk management. Risk management is very important topic because many people trade very good, analyze very good, but overall they end up in negative because many times they try to recover losses. In that intention, they can't control themselves and taking extra risk unknowingly. In that process, they lose more and more money. So, in that situation, you can't manage risk. If you can't manage risk, you can't survive in the market. So, in this video, I am going to tell how to survive in the market with exact reasons, rules and logic behind risk management. Okay, I will try to explain it in simple terms. First of all, risk management is not only controlling losses. Before controlling losses, you need to control your emotions. It's very important. When your emotions goes high, then your intelligence will goes low. In that process, you will take wrong decisions and make more mistakes. So, first be in a emotional balance. Okay, let's see how risk management works. For example, if I buy HDFC Bank share at 1600 level, my stop loss at 1590, target at 1620. So, in this case my risk to reward is 1:2, means I am risking 10 rupees to make 20 rupees. Next, same HDFC Bank, if I reduce my target 1620 to 1610 and my stop loss remains same 1590. Now it's 1:1 risk to reward ratio. If I lose means 10 rupees, gain means 10 rupees. Next, same HDFC Bank, my entry at 1600, my stop loss at 1590 and target is 1605. In this case, my risk to reward is 1:0.5, means it's below 1:1 ratio. Risking 10 rupees, taking profit 5 rupees. You can't take such trades in your life. It will happen because when you not maintaining strict stop loss. When market is going favor to them, they tend to book profit. But when market is going against to them, they live like that because they will not accept to book loss. It's very big mistake. So, we need to maintain strict stop loss. So, to survive, we must maintain 1:2 risk reward ratio. 1:1.5 is also okay. Sometimes market is very bullish and very bearish. At that time, more than 1:3 we will get. So, remember, below 1:1 ratio, very bad and no entry. Next, 1:1, I don't agree. 1:1.5, 1:2 and 1:3 we need to maintain compulsory. This is condition number 1. It says know your risk to reward ratio. It's like triple R. Next, condition number 2. We need to know how much risk we are going to do in each trade. It's called RPT, risk per trade. Some people do like this. Whatever capital they have, they just think, I don't want to risk more than 500 per trade or 5000 per trade, like that. Okay, I accept that your intention is don't want to lose money, but it's not a proper way to protect your capital. So, we should know perfect rules about RPT. Okay, I will explain this concept in condition number 3. Then only you can understand correctly. Okay, let's see condition number 3. It says we should know about target hit rate. It means out of 10 trades, how many trades are hitting target and how many trades are hitting stop loss. For example, out of 10 trades, we want 5 means it says out of 10 positions, 5 hit target and 5 hit stop loss. It means 50% win rate. Okay, now let's see. If I am trading with 1 lakh capital and I want 10 trades back to back. Oh, back to back 10 trades I want. Now I think I am a genius. Okay, after 10 wins, I got a continuous strike. Means continuously I lost 5 trades. Continuously if I lost 5 trades with the RPT of 30%. RPT is nothing but risk per trade. So, if I lost 5 trades with the RPT of 30%, means I am risking 30% in each trade. Before that, how much capital I gain, no matter. But if I get continuous strike with 30% RPT, then 4 to 5 trades, my capital will wipe out like that. Suddenly genius becomes fool because I am maintaining 30% RPT. So 30% RPT we should not maintain. Next, if I reduce 30 to 25% RPT, same 10 wins, 5 continuous losses, then also I will lose everything. So 25% also very bad. Next, I will maintain 20% RPT. Then also I will lose everything. So how to survive from continuous strike? Let's see. Because of this issue, big bulls and big companies like mutual funds, before they enter, they already made all calculations. They are very clear that they don't want to risk more than 1% of their total capital. Compulsory they maintain 1% rule. So my rule is to not 1%, it's 3% from my total capital. It does not matter how much capital you have. Our rule is to not risking more than 3% per trade. For example, if you have 1 lakh capital, then in one trade you should not lose more than 3000 rupees. It's 3%. This is condition number 2, RPT. Third condition, we already know that maintaining more than 50% hit rate. So still now we learned 3 main conditions in risk management, but real concept with main twist starts from now. So listen carefully. Okay, so what will save us from risk management? Is your stop loss? No, only stop loss will not save you. The secret is only pro traders know. That is position sizing. Yes, position sizing. Position sizing plays a key role in risk management. Position sizing means quantity. Quantity is nothing but how many shares you brought or sold in market. So we know that stop loss in rupees, RPT and hit rate, but we don't know how many shares we need to pick. To match quantities, there is one amazing formula, that is quantity is equal to RPT divided by stop loss in rupees. We know our RPT, that is 3%. 3% is fixed, no changes in that. And we know that stop loss in rupees, it depends. Remember, stop loss in rupees is kept based on holding period. Some intraday traders keep stop loss below 5 minutes or 15 minutes candle, or some short term traders keep their stop loss below hourly or below resistance level. It depends on how long you participate in the trend. Okay, we know RPT and stop loss in rupees. So we need to find quantity. Formula is quantity is equal to RPT divided by stop loss in rupees. Assume that I have 1 lakh capital. In 1 lakh, our condition number 2 says not risking more than 3% from our total capital. So RPT is equal to 3%. In 1 lakh, 3% is 3000. Next, I kept stop loss in rupees is 10 rupees for HDFC Bank. Now 0 cancel, we get answer 300. So quantity is 300, means you can't buy more than 300 shares in HDFC Bank, and you can buy less than 300 quantity, maybe 250 or 200 or 299. Clear? For suppose if you don't know the formula, instead of 300 quantity you place 500 quantity and stop loss 10 rupees. Then 500 into 10 rupees, it's 5000 rupees. So you are risking more than 3%. That means you are breaking rules. That means we can't survive in the market. That means market tells you that you are unfit for trading or investing. Understand correctly. If you understand correctly, these are game changing rules. Okay, let's see one more example. Now I have 2 lakh capital. I need to buy Axis Bank share. I will enter at here at 950 level, and I kept stop loss at here 938 level. It's 12 rupees risk, and obviously my target would be double. Let's apply formula. Q is equal to RPT divided by stop loss in rupees. In 2 lakhs, 3% is 6000. RPT is 6000. Stop loss in rupees is 12 rupees. So we get answer 500. So we can't buy more than 500 shares or quantity in Axis Bank. Clear? Got it? Next, fourth condition. That is, you can't take more than 2 stop losses in a day. These are very important and very rare content I am sharing with you. Never ignore. So can't take more than 2 stop losses in a day. In one day 2 times hit your stop loss, then close your PC or trading. If you don't close your PC in recovery intention, you may lose everything. In starting days I did this type of big mistakes. Now I hope you won't do such mistakes after watching this video. So we need to think this is a test match. Always try to protect your wicket in each and every game by following rules. Don't think if you risk more you will make more money. It's not a correct. If you risk more you will lose more. Okay, the fifth condition is in a day 2 times stop loss hit we need to close our PC now. Same, continuously 6 to 8 stop loss hitted back to back means then stop trading for couple of months, means you need a big break. So stop trading, go for a practice, back test, next paper trading, go for a vacation or some beautiful place or temple, fresh up your mind. Next come and restart trading after 3 to 4 months. So you don't want to lose more than 20% of your capital. If you keep on losing your capital means with capital you will lose confidence also. So protect your capital and protect your confidence by following rules. These are very important golden rules I shared with you. Okay, I will repeat some key points. Risk management is not about stop loss, means only stop loss will not save us. Stop loss with quantity will save us. Next, maintain 1:2 risk reward ratio. 1:1.5, 1:2, 1:3 also very good. Next, know your risk per trade and target hit rate should be more than 50%. Next, remember formula Q is equal to RPT divided by stop loss in rupees. Next, not more than 2 stop losses in a day. Next, 6 to 8 stop loss hit back to back, stop trading. Next, stop thinking like this. In this month, I need to make 50k or 1 lakh or 5 lakh. It's not about how much money you make in a month or a year. It's about how many times you follow your rules in a day or in a week or in a month or in a year. Next, and very importantly, you need to be emotionally balanced. That's it. Next, I will cover adding position sizing in positive time with trailing stop loss. If you understand this both concept correctly, then you will hold winning trades and not bother about losing one. Soon I will cover. That's it guys. Good to see you in next video. Jai Hind.